Chris Vermeulen is back. He is a chief market strategist at the technicaltraders.com, and we'll be getting his outlook today. Welcome back to the show, Chris.
Hey, thanks, David. Always a pleasure.
Momentum has had people spooked. The S&P is down about 5% from its peak. Where is this headed from here?
Good question. The market's getting pretty oversold at this point. It's obviously 5% correction is starting to get people pretty nervous. We're seeing the VIX elevated, put call ratio elevated, meaning people are betting leverage on the downside. I think this market is about ready for some type of bounce or pause. I don't know if it's going to have a lot of life behind it. It's really tough to say until we see what type of chart pattern unfolds over the next potentially next week or two, if it has a bearish vibe or a bullish vibe. But overall, the market always has a stair-stepping action up and stair-stepping action down. So I do feel like it's primed and ready for a bounce. And the question is it the bounce or is it a bottom and we continue to rally into May or into the election? Again, I can't tell you what's going to happen yet, but we definitely need to see how this fear plays out. Does it turn into a big wave of distribution selling and a lot more volume, or is it really just the first bout of big profit taking and trying to shake out a few short-term traders?
I was going to ask you if you think this is the beginning of your, I can't remember which phase that would be, but the end of the complacency phase into the next phase.
Right.
You've shown your cycle chart many times before. So, is this
Yeah.
the beginning of that or not yet?
Yeah. So if we were to look at it from that kind of angle, I'll show people the chart you're talking about here, which is these different stages. So I still believe we're in a stage three. The general stock market had topped a long time ago, and it's not hitting new highs. When we look at the majority of individual stocks, individual sectors, they're actually in this stage three complacency move. The indexes are hitting new all-time highs, but they're masked by the big techs. And as you were just bringing up here, the market participant kind of emotions, this complacency move right here. I believe we're kind of still in this complacency move. I think the market is going to continue to struggle. People are going to buy this dip. We're seeing kind of buy the dip mentality today in miners, as you and I are talking. It's big bout of selling, but we're seeing some waves intraday of strong buying of people trying to buy the dip. But we're still in the complacency mode, and I think we still have quite a bit more time. I think we could still see several more months before we get a real feel if this market is going to go a whole lot lower or if this is just a pullback. It is a fairly controlled pullback, the overall stock market. When we look at the SP 500, this is a fairly sharp pullback, but it actually seems very controlled. And it's the type of pullback that can have a very sharp knee-jerk reaction bounce and keep going. And there's that kind of mentality you and I talked about, I think last month, about potentially sell in May and go away. I think this is a little bit of a shakeup, trying to buck people out of this bull market move. And we might actually rally and push higher going into May still.
So you use the word sharp pullback, and if you take a look at what's happened, it's down about 5% over the course of April, so the last 3 weeks. Typically speaking, now just historically, if you look at the historical charts, Chris, if something corrects by 5% over 3 weeks, would you consider that an aggressive timeline for such a pullback of this magnitude?
Yeah, I would. That's a pretty sharp pullback. If we take a look at just on average, some of these, that was 7%. This one is a little bit more, 8. All of these pullbacks are generally 5, 6, 7, 8, somewhere.
How long does it usually in the past take to correct by those percentages?
I mean, it really depends on the stage, the way the
Sure.
market is in. This is a very normal pullback. This type of pullback usually has one of these bounces after it, a sharp bounce. And the big question right now is it one of these bounces, which is going to have a fairly decent move, or is it like something that's going to push to new highs? Like, could we see it just have a V shape and continue to go higher? But overall, I mean, we really need to see how this is going to react and how a lot of different sectors and commodities react during the next couple of weeks. So once the market starts to bounce or find stability or trade sideways at least, what are precious metals doing? What are utilities doing? What's the dollar doing? What are small caps and large caps and dividend stocks doing? We take all those into effect. We can get an idea of what the general masses, the big money flows are doing. And then we can figure out is money aggressive in actually moving back in to try and play another move higher, or is this just a bounce and people are actually starting to sell off aggressive stocks and move to more defensive plays and dividend plays, things like that. So I mean, it's really hard to answer how long it's going to take, but looking at this chart, it usually from this point here, we could see potentially a peak and a bounce 2 weeks from now. So we might see higher prices 2 weeks from now. And then the question is that a peak and we're going lower, or is it going to build a launch pad to go higher? And
So
that's what we
what
need to see.
so I guess the viewers would be wondering to themselves what indicators you would be looking at to make that definitive call, whether it's a bounce up from the next peak or it's going to be the end of the bounce and we're going to go lower. What would you look at?
Yeah. So overall, I mean, it comes down to more or less price action first. So we're going to want to see price start to move higher, hold its ground. We're going to want to see money moving into growth stocks. We're going to want to see more or less the 20-day moving average sloping up and price above it. We want to see price get back up above those levels. So right now we are below all of the moving averages. If I was to just zoom in here, we are underneath this light blue line, which is the 5-day. We're under the 20-day, which is the pink, and the 50-day. We really want to be back above those. And we kind of want them to be, trading sideways or up. So there's going to be a bunch of technicals saying, okay, well, right now the momentum is down because all the moving averages are down, prices below it. We're going to want to see the moving averages flatline or start to move up, and for price to be above those. That is the definition of an uptrend: higher lows, higher highs, and on average, price trends are going up, which the moving average is a great way to see what those different price trends are. So we really need to see this selling dissipate, come to an end, and we need to start to see waves of buying. And that's kind of the core thing. We follow price first, and then we can use other things to identify if maybe the washout low is here. For example, if we pull up the VIX real quick, today,
Yeah.
the VIX had a huge pop in the last trading session. If I zoom back a little bit, you can see it's popped way up into the nosebleed section. Last time we got up here, the market had a very significant low. And so we're seeing that. We're seeing a lot of fear at a point when the VIX is high, it's time to buy, is the saying. And when everybody's fearful and dumping shares, that usually means, okay, the market's ready for a bounce because most people have just panicked and they've dumped their shares, which is why price fell so quickly. And now we should have a bounce. The question is bounce or the beginning of a new rally. And nobody will know that until it takes place. So we just need a strong enough bounce to get price above the moving averages. And then if things firm up, we can hop on board and see if that new trend has got legs behind it.
When you look at the volume data, how do we know if most of the volume on a given day is buying or selling? Are there tools for that?
Yeah, so I do have this 30-minute chart here on the left, which is telling us I have these indicators on the top, which really anyone can pull these up on pretty much any charting system. You go and you find the symbol for the New York Stock Exchange, down volume and up volume, and you just divide them and you get two different ratios. So more or less, when we see the red line here spike above this, I just drew a line on here around 3. This is telling me there's 3 people dumping shares or shares being hit on the bid, being sold like a market order. They just want out. They're panicking to every one person wanting to buy. And the way that I see it is when we're in a downtrend like we are now, red bars, whenever we get these spikes in more or less, this is like FOMO. The red here is people are actually buying. There's 3 people buying to every one person selling. And when we're in a downtrend, as soon as there's a lot of people buying, the general public, the big institutions that are kind of creating these trends, they sell into it and we see it go lower. Same with here. We had a little bounce last week and then it got sold into. We had another little bounce. The institutions just keep selling into these bounce. We had a tiny little gap up and bounce, but people were piling in. These red things are people trying to pick bottoms, technical traders picking bottoms, and the institutions sell into that volume. And then the flip side is when we're more or less in an uptrend, I look at the opposite ratio, and I cover this all the time with subscribers in my morning video. But when we're in an uptrend with green bars and we get panic selling, typically we start to see the market rally from these levels. Usually you'll find some type of support. It'll trade sideways. Now, this is when the trend started to lose its momentum and rolled over. But generally, when we are in an uptrend, we're always looking for these spikes, and they're usually major, significant standout lows on the chart. So there are ways to figure out, is everyone greedy or is everyone panicking? And we can see that very clearly in an uptrend when everybody's greedy. I always tell subscribers, I'm like, everybody's piling in, everybody's bullish, expect a little bit of a pullback. The market's going to shake them out. We're going to see a spike of fear. Market will get oversold, and then we're going to start to see it push up. And we see that all the time. The market has pauses and pullbacks. with these little tools. So it's just a short-term indicator, but it does give us a glance that I can quickly tell. I can tell what subscribers and traders are feeling because if we've got a big wave of panic or selling, I can be like, hey, I know everybody right now is nervous. People are dumping shares. You want to get out or whatever the scenario is. And I can connect with them and say, listen, this is normal. This is actually good. This is telling us, this should happen over the next 2 or 3 days. So I can kind of mentally prepare people. And these little waves of volume, reading volume flows on the New York Stock Exchange really help keep your mind in sync so you don't panic during these quick extremes.
Do you ever look at put call ratios, Chris?
I do. I don't trade based off them, but I do like to bring them up and talk about it because typically when we see the put call ratio go over one, like we had a huge spike up here a couple sessions ago. When it's over one, obviously it means there's people buying when it's more puts, they're betting on the downside. And whenever we see it spike up really high, it's usually the VIX is usually spiking and everybody's fearful. They have already now sold their shares and now they're buying put options to bet, to take leverage on falling markets. And so I love it when we have panic in the market. The volume flows, as I just showed you, show that people are dumping shares. And then we see the put call ratio spike. This is something I bring up whenever we see it happen. I tell everybody, listen, everybody's betting on the downside. They're all probably about to get slaughtered because this is how the market works. It spooks everybody and then flips direction. So I do follow it, I watch it, but I don't use it for trading. It's just to show people what other people are thinking and feeling, and that we don't want to be stuck in that emotional herd.
The weekly commitment of traders report has been net short on the S&P 500 speculative positions for quite a number of weeks, basically for quite a number of months, actually. Recently, it's been just the last report has come in positive. If you're looking at something like that, do you trade the counter trend? In other words, people are starting to finally feel positive sentiment. The net positions are positive, and so you're short, or do you ride the wave? I'll show the chart on my screen on my end, but I just wanted to bring that to your attention.
Yeah, I used to follow it years ago, like maybe 10 years ago, but it's such delayed data.
Yeah.
And I have learned that almost no one's perfect at the market. Even the institutions don't know what's going on. I mean, they lose more money than a lot of individuals. So I don't really use it anymore. It's interesting to see what the commitment of traders data is showing, what the large cap traders, the speculative and the commercials. But overall, I never really pull a whole lot of insight out of it because I'm not trading I mean, it's like 2 weeks delayed. And then I'm playing shorter term trends when the trend can change direction within that whole window. But it is always kind of interesting, but I don't read too much into it at all.
Well, I know this next question is somewhat unscientific, but generally, how do you feel right now? Are you feeling a lot of fear from this pullback? Are you feeling that the markets are in a more fearful stage, just based on what's going on in the world and perhaps what's happening right now with momentum?
Yeah, I do. It's funny because I have to try to segregate my brain. Our pocket of traders, because we talk about this and we see pullbacks coming and we see them unfolding, we see things weakening. This isn't a surprise. We've been talking and waiting for a pullback like this for several weeks. So we're not panicking. We're actually excited because it's resetting a trend and it's going to set us up for a new type of position, either as the market rallies again or for us to continue to profit from falling pricing using different assets. So, from our pocket of traders, this is good. This is a cleansing event. It's resetting things for another fresh run. As we can see here, like for example, on our SP 500 trade, you can see the last trade, and then you can see the trend exit. Beautiful trade. I mean, I think we did about 26% on the SSO ETF trade. Super simple. And now the market's resetting. But the general public is very fearful. I mean, the VIX is high, pretty darn high. The put call ratio on average, you look at the 5-day average, is moving up. So people are betting on falling prices, and this is a market top. So it really depends on the group you're talking about. But I can feel fear. People are getting very nervous right now, and
Hmm.
to me, that's a sign the market's probably going to have some type of bounce, and we just have to see if it's a bounce or the start of a new rally.
Interesting. That's an interesting perspective. When there's fear, typically that means there's going to be a bounce. Can you just walk us through that logic? It sounds very contrarian.
It does. So, and I mean, this is probably going to confuse people, and it probably might not make a whole lot of sense, but the market climbs a wall of worry. So it keeps going up. Everybody's constantly worried about the market topping, and it leaves people behind who are constantly trying to pick a top. And then finally, when we get into this kind of phase right here, this is a wall of worry. So a wall of worry, the market can go up, but when there's panic selling, everything kind of gets pulled back, gets sold off because they're now actually taking action and ejecting out of a trade. So there's a difference between people being nervous and then people actually full on panicking and saying, "Just get me out, get me out."
Yeah.
And so that's what we're seeing is panic. People are dumping shares. We're seeing, when there's panic like today and the last couple of days, we start to see even defensive plays pull back, like precious metals and miners. Everything gets hit. So there's a big difference between panic, which is like dumping shares, and people just being worried.
Okay. Um, let's take a look at some other assets now, Chris. So
Mhm.
thanks for your analysis on stocks. Gold is something we have to talk about. It's run up even more since last time you were on a month ago. At one point, breaching $2,400. It's come down a bit since then. Okay. So what is this? A wall of worry or not?
Well, I mean, I'd say gold is broken out. Gold's in a bull market phase. It's reached its targets. You and I had talked about these Fibonacci targets from before, how gold came up, hit this target, and we're expecting volatility and some type of pause, which is what it's doing. A lot of everybody seemed to be getting totally sucked into gold and silver and miners, and everybody wants to talk about it and wants to own it. And I keep telling everybody, just be aware, we've hit a target. It needs to take a breather, just like over here. We need a pause before it goes higher. So this is really good price action. I think the fact that it's stalling here and consolidating a little bit is a good sign. It's definitely frothy, just because everybody seems to be talking about it, and people who are getting in have chased pricing. We saw volume ramp up in a big spike in gold. So there's been lots of people piling in, and now it just needs a bit of a breather. But like right now, it's just trying to work off the short-term traders. Anybody who got in late is now panicking. This big red bar triggers a lot of fear, and they'll eject out of the trade. But overall, gold is in a strong trend. The next stop, I think, is about 26, 2,700, based on the longer term charts. If we look at the monthly chart, it's very clear we are in a bull market phase. If I just zoom out here, we can see with a Fibonacci extension, we've got this rally and we had this controlled pullback. And the next upside move is, right up here, 2,600, 2,650, somewhere in there. And right now we're at the 618 level. So it's blown up through this level. If it pauses here for a couple of bars or a bar or two, then it's most likely going to run up and hit 2,600. And I believe it could pause for a bar or so, which is a month, take a bit of a breather, shake people out. If it doesn't shake them out, the market will generally wait them out. So people are expecting gold to just keep going. But if it trades sideways long enough, people give up on it. People are super impatient. So give it a bar or so, and then boom, we could see this up at 26, 2,700,
Yeah.
which could coincide with the stock market, struggling or even moving lower. And eventually, if gold hits 26, 2,700, that actually might be, the time where the stock market is now actually really about to collapse in a much bigger way. It'll be interesting to see how all this unfolds.
I'm curious as to why the reverse logic to what you said about stocks wouldn't really apply here. What you said earlier about stocks being down about 5%. I'm talking about the S&P down about 5%, 6% from its highs. And then with the sentiment looking
Mhm.
fearful, that may be indicative of a bounce. Could the reverse logic apply to something like gold? I'm just using gold as an example. It could be anything else that's moved like this. If anything has moved to this degree to the upside, wouldn't that indicate to you, Chris, or maybe not, that it's time for a pullback?
Yeah, and I think a little pause here is what it's starting to do. But what's nice about gold is, for example, if I won't pull it up here, but long story short, people are into gold miners and silver miners, and we're in a window right now, which actually the cycle chart here shows it very clearly that we're near this blue cycle. Here is a stock market. Here's a stock market top. typically precious metals and energy stocks do very well. Same with industrials, capital goods, which they're screaming higher as well. Um, what's interesting is this is the just the type of market condition that even if we get panic selling in the stock market, this pocket of stocks can buck the trend. And so we saw this back in 2008 where precious metals and precious metal miners and energy miners and the industrial sector kept moving higher while the stock market even started to sell off, even with panic selling. And so we're in this one particular sweet spot that no matter, even if we get panic selling in the stock market, these assets I think can still hold their ground. I personally like precious metals like gold or silver better than the stock plays. And if you were to look back in time of how miners moved versus gold and silver when the 2008 stock market topped, keep in mind, miners are stocks. They're in the stock market. So when there is selling in the stock market, it's naturally pulling down on those miners. They might still be able to grind their way higher, but very, very small moves. They'll
Mhm.
be able to make nominal new highs. But gold and silver, they're not in the stock market. They're a commodity. They're
Yeah.
disconnected. So they don't have that bear market pull on them of panic selling. And so they can continue to rally, which is why we're seeing them kind of, especially gold, really run free and wild to the upside because it's not directly connected into that stock market and that emotional wave of selling and things like that.
So I'm looking at gold versus the GDX index, and you can pull that up on your screen as well. Year to date, gold is up 13%, GDX is up 5. So year to date so far, gold has still outperformed. However, if we zoom in, if we just take a look at the last 3 months, gold's up 15%, GDX is up 19, 20%. In
Yeah.
the last 1 month, the GDX is up 9%, while gold is up 7%. So, like you said, it's really shown through these charts that the GDX, the miners, have been moving up a lot more in the last month or two. It's been slow in the first half of the year, or for first month of the year rather, but momentum is just starting to pick up. Is there a reason for that? Is that just because gold's shooting up to the moon right now?
Yeah, I mean, yeah, gold's taking off, so everybody wants to go and play the leverage play around them. I mean, miners have had a very big move. They always outperform percentage wise, but miners are still really chat trapped. They're still making long-term lower highs. They've had a really nice run, but they're into major resistance. Percentage wise, yeah, they've done very well, but they're not breaking free. They're not in like this, all-time highs, no overhead resistance. Um, and this is what has me thinking that gold is going to have a nice run, but I don't think this is the start of a huge rally in the precious metal space yet. I still believe I still believe miners could actually rally fairly significantly and break up towards that $40 for GDX here and have another move. But overall, I still think we're going to eventually go into a bear market. It will pull even gold and silver down later this year. And then when the market starts to recover, I think that's when the miners and precious metals will start their much bigger run, which gold will probably be in the 3,000 range beyond, and miners will start a multi-year rally and probably blast past the 2011, 2012 highs that we saw, a decade ago.
So you do think gold has the potential to reach 3,000 at some point?
I do. Yeah, I think it's going to probably get to 26, 2,700 and then consolidate for a year or so. And then,
Mhm.
depending how long the bear market drags out.
Right.
And then I think it's off to the races for, a 3, 5 year rally. So I'm really excited for it, but
Okay.
it's going to take time.
Yeah, just to clarify, 3,000 wasn't your year-end target for this year. Actually, it's the year-end target for some banks. Citibank, $3,000 by the end of the year. Um, no, I'm sorry, I got that wrong. $3,000 by the end of next year, and then
Okay.
Goldman Sachs is calling for $2,700 by the end of this year.
Yeah, I
So
think that's probably dead on. Yeah.
yeah, the banks, yeah, actually, so that's kind of in line with what you're expecting. So even the large institutions are still very bullish in gold. Okay, well, that's interesting. Thanks, Chris. I'm just wondering why the miners are, there seems to be some risk off sentiment in the markets overall, but the miners are still doing well, right? I'm curious as to what the miners follow more, the stock index or gold. If it has to come to one of the two, let's say they're moving in different directions, what do you think is going to happen to miners?
This is the hard part with miners, and I think I've touched on it with you before, is there are times where GDX and silver miners will move in sync with the stock market. very in sync. Market goes up, these go up. And then there's also times when they completely decouple, and we can see miners and everything rally for a month or two and have these huge moves while the stock market goes down or trades sideways. And this is like that extra, the market is difficult enough how it is, but when you throw in this randomness of you never know when miners are going to work with or go against the overall market trend, it adds a whole new wild card. So it makes it very difficult. I believe that we're going to see probably miners buck the trend, and if the stock market struggles here and goes sideways, or maybe even continues to go lower, I think we could see miners hold their ground, and then any up day there is in the stock market, we'll probably see miners push higher and kind of lead the way. So I do think they're going to buck the trend and hold their ground. I think we're in the stage right now in the overall cycle of the economy and the stock market and in sentiment that they're coming to life and they're about to break out of this big down channel and do well. So if I had to pick something, I'd say they're going to buck the trend and go higher. But they are very much so a wild card just because they have that one aspect where they can decouple or stay coupled to the stock market, and you just never know when it really is
Hmm.
going to have a disconnect.
How do you feel about silver then? Is silver set to outperform gold or not so much? I think silver has been lagging gold this year, if I'm not mistaken.
Yeah, I like silver a lot. It's right up into resistance. It kind of got right up to these highs that we saw back in 2020. Um, it's had a really nice pop. Let's take a look at the monthly chart for a kind of a bigger view here. But silver's got potential to rally to roughly, if we were to look at it, somewhere right up to around 36 dollars an ounce, which is a fairly significant move. So, for example, um, when we saw it back in 2006, 2007, we saw like the multi-year consolidation. Gold, silver miners rallied up into the stock market top. In fact, some of the biggest months here was when the stock market was starting to fall and metals kept going higher. Gold and silver did very well. We've just had a consolidation. We're starting to see silver run up. I think it could run up to 36. And then the stock market, it will start maybe a stage 4 decline. It'll definitely be struggling, I think, over the next few months. And then silver could pull back and consolidate. And gold would do the same. And then I think we're off to the races for very significant moves in silver. So I like silver. I think gold, silver, I think all of them have upside potential here, but there will be some type of pullback. And the question is, how much will they pull back? Because the last bear market that they did this same scenario, we did see silver pull back about 61%. It's quite a haircut. If you're expecting to the moon and not looking back, to get hit with 61% could hurt. So it'll be interesting to see where this goes and then how far is it going to pull back during the next bear market. I believe it'll hold its ground fairly well. I think we're in a kind of a very good storm for
Hmm.
people wanting to be into metals. I think it'll be supported fairly well versus big panic in that space. But we'll just have to see how that unfolds.
The gold silver ratio currently at about 85. It was at close to 90 just a couple of weeks ago. Is that a useful tool for you at all to see I guess underperformance or overperformance or outperformance rather of these two metals relative to each other?
I don't use it for investing or anything. Obviously a higher ratio says, hey, silver's a little undervalued, which makes sense. I mean, if you just look at the chart, silver is way down here, gold is equivalent to up here. So gold's hitting new all-time highs. So you'd think silver will play catch up. It generally does. I think if the ratio is high, it might be better to have a little more weighting in silver simply
Yeah.
because of that potential. Um, but yeah, I don't use it for trading, but it definitely shows silver and miners, I think, move very similar simply because they're both more of a speculative play. They get hit really quickly when there's panic. They drop, they get sold down. Where gold is kind of accumulated, people who buy gold just kind of sit on it forever. They know it's slow moving. They're not really looking for massive gains. They're looking for stability, consistency, a safe haven. Silver and miners are like people want to make a ton of money. They want to hit that grand slam. And when it starts to
Yeah.
backfire on them, they panic out and it drives the price back down. So it's
Right.
just a bit different mentality in how they move.
Let's take a look at the DXY now. I have to show this chart on my screen. I'll show it as a comparison, but you can show the DXY on your screen as well. The DXY versus gold. Historically, they've moved in opposite directions, right? Makes sense. Gold has always been seen as a counter dollar asset. Um, Not so much the last month. In the
Mhm.
last 6 weeks or so since March, they've been moving in the same direction upwards, which is very rare. And, a couple of days or a couple of weeks might be an oddity, but a whole month now, it's kind of a trend. What do you make of this?
Yeah, yeah. I mean, they can move together. There's waves and months where they move together.
Yeah.
I think there's a lot of fear in the market. When the stock market's got a lot of fear, we tend to see the dollar do well. And I think we got enough global fear going on that gold is also people go to it as well, and they're both moving up. I mean, we got wars going on. A lot of people are nervous about stuff. So I think the dollar is going to do very well. I think it'll eventually the big rise in the dollar. I think later this year potentially it will mute gold. Probably when gold hits 26 or 2700, the dollar will probably start really rocketing higher, and kind of neutralize it to some regard. But yeah, it's interesting. They have been moving up together, and I like. It's funny. I like them both. Yet everybody's like, "Well, you can't own both." They do the opposite. I'm like, not always. They're right now seems to be the window where I like the dollar. We're actually getting pretty close to wanting to get into the US dollar as a long-term play, like UUP, which is just the dollar index ETF. And I like gold. I mean, they can both move up. If they're both moving up on the charts, I mean, you can trade them. Like they don't always go the opposite.
Okay, so you're expecting then this relationship to somewhat hold if you're expecting both to go up?
I'm expecting both to probably move up over the next month or two. But I do eventually think the dollar will start to just continue to move higher, and gold will start to struggle
I see.
and top out.
Okay. Another interesting asset class, oil. Uh, well, I mean, oil's moved up quite a bit over the last year or so. It's recently just seen a pullback along with stocks. I don't know if this is indicative of anything, a sharp pullback in oil, or if this is just a normal course of action for oil. It is a volatile asset. I'll let you comment.
Yeah, I mean, oil has done, it kind of had this bottoming formation. It went into a big downtrend, put in a bottom, and then tried to eat through this resistance area, which it has. You can see here it's pulled down to the 50-day moving average, which is very similar. You get a bottom, you get a breakout, eventually you get a pullback to the 50-day. So it's nothing out of the norm. It was a big down day a couple of days ago that we saw, but overall, at this point, it's not really out of the norm. It could very easily ramp up and move higher. We This big down day was a day that almost every asset went down. It felt like a bunch of institutions or somebody all hit the sell button on everything. They're like, let's just lighten up our portfolios across the board and move to cash. Everything kind of got hit that day. If we look at the energy sector stocks like XLE, obviously, it got pulled back as well, but it has been screaming to the upside. It broke out of a base long before the energy oil did, and really just screamed higher. And this is really the first pullback to it. And usually, the first pullback gets bought into, and it's starting to get bought into, and it could keep going higher. So I'm still bullish on the energy space, very similar to gold. I believe energy and oil and energy stocks could continue to move higher together in right now.
Okay. Overall, what is your favorite commodity right now?
Um, I would say it's probably gold. Yeah, I would probably just say it's gold. I like gold. It's pulling back and pausing. I believe it's going higher, another, a couple $100 higher. So I like it because it's slow, it's consistent. The chart patterns are moving just with Fibonacci levels. The momentum's all working out. So I really like it. And we're in this scenario, this stage of the market where it naturally wants to do well. And seasonality wise, I think it naturally wants to do fairly well also.
Is gold going to be the or one of the top performers of 2024 in terms of asset classes this year, do you think? Or do you think anything else could beat it?
Um, it'll be interesting because if the stock market does start to roll over and sell off, I think we could see gold eventually also start to trade sideways and pull back. And I think the US dollar has got actually potential to put in a pretty big move. I like the dollar. If I had to pick probably something to be in, I think over the next year, it most likely could be the dollar, believe it or not, the dollar index. I think the dollar could have a very strong rally, and I like it. It moved very slow. You can put a lot of money into it. And I think we're in that phase. So it'll be a toss up. I think gold and the dollar, they're both a good play. We just need to see how they unfold going forward.
Yeah. I'm just going to take a look at the relative performance. So yeah, the stock market's SPX is up about 6% year to date. Gold is up about 5%. I mean, they've done equally well. Obviously, the stock markets have had a big pullback beginning of the year, and then climbed up, but gold's been more steady. Okay. Well, Chris, tell us about your methodology a little bit. So asset revesting. Um, you're not a day trader for those of us who don't know you very well, where I've seen our prior shows. I encourage people, by the way, to click on the link up here and watch my last interview with Chris every month. He comes on once a month and revisit his calls. Um, but yeah, generally speaking, you're not a day trader. You're not a super long-term investor either. You're not a value investor per se. You're somewhere in between. Am I getting that right? Tell us about your work.
Yeah, yeah, exactly. So I kind of coined the term asset revesting. It's a new category of trading and like active investing or passive trading. And the way I look at the markets is I don't believe in diversification. I don't believe in holding a whole bunch of assets that, when the markets get hit, some might go up, some are going to go down. You end up with a really average return. So my belief is I only want to hold assets that are going up. If they're not going up, I want to move to a different asset that's going up. And I like to look at the market like the ocean in terms of if we have a rising tide and the tide is going up, we want to own stocks. We want to focus on a stock market strategy. If the tide is going down, we want to focus on owning different assets and get out of the stock market. And right now, we're kind of back still in this rising tide mentality where we want to be in. And so, understanding what direction the underlying market is doing gives us kind of that insight of how we want to attack these markets. And then we go into a shorter term strategy where we trade the index ETFs, we trade bonds, the dollar index, bill, which is like a treasury note, a dividend paying monthly dividend. And so we actively navigate through these markets to make sure we're owning things when they're going up. Where when the market's red or down, we're holding the US dollar index or something else that's going up in value. And so we actively just rotate through the market. There's generally about 5 to 12 trades a year. We pretty much have one or two ETFs open at a time, one position generally, which is like the stock market. And as we scale out, we move into a bill, which is like a cash dividend, monthly dividend. So it's a very different strategy where we want to be able to move our entire portfolio in and out of positions just enough to catch these waves in the market
Mhm.
and navigate it that way. And it
How,
works in retirement accounts and all those things.
how much cash did you say you're in right now relative to your whole portfolio?
We just moved into cash last week. So we're 100% in cash right now, collecting dividends in a bill. So we're collecting like,
Mm.
4.5%, broken up through monthly dividends right now until we get a new opportunity to benefit from falling prices or to get back long if this market turns around.
Just off topic as an aside here. Someone told me that doing exactly just that is not a bad long-term strategy, especially if you consider inflation going down. If you think inflation will stay low or is not going to reignite, then yeah, 4 or 5% on T-bill, you're making what, a net 2% on returns. It's not bad.
Yeah, I mean, I don't look at it like everybody else. I'm
Yeah.
like, I would rather hold something that I'm making, 4.5% a year minus everything else inflation. I'd rather hold something making 4% than hold something that falls 15 or 20%. So I don't really care what it nets out in the end. I just want to make sure I'm holding something that's positive, and I don't want to hold stuff that's going down. And if you're just constantly always in things going up in value, I mean, we don't have to swing for the fences because we're constantly hitting first, second, third base hits, and we're not taking any big losses. And that's the real key. Is I don't look at it like some people say, well, I don't want to go to cash. I'm losing money. It's like 2%, as you said. Well, it's way better to make 2% than it is to lose 8% or 5% in a couple of weeks, like on the SP 500 or the stock and bond portfolio, which is down really
Yeah.
sharply as well. So you have to stop thinking about like I got to beat inflation and just start thinking like I don't want to ride things down. I just want to hold things going up. And everything changes when you focus on that. It's like the markets become much more relaxed when you understand how to identify these things.
Perfect. Chris, great talk as usual. Follow Chris in the link down below. Where can we go to follow your work?
Yeah, they can go to thetechnicaltraders.com, which is my website where I focus on ETF trading. So you can go here. I do a morning video. I walk through the charts, very detailed each week, and I share every trade that I do. And we have auto trading. So if you don't want to trade, it can be executed in your brokerage account for you, all those things. But yeah,
Perfect. All right. Follow Chris in the link down below, and we'll see you again soon. Thanks, Chris.
Take care, David. Thank you.
Thank you for watching. Don't forget to like and subscribe.